Welcome back. So, blame the Federal Reserve for the market selling off? The president thinks so.
I think your tech stocks have some problems, but that'll come back. But no, I think we're going to do very well. I'd like to see the Fed with a lower interest rate. I think the rate's too high. I think we have much more of a Fed problem than we have a problem with anyone else.
The sell-off in stocks has been largely about worries over economic growth slowing down. I sat down with Federal Reserve Bank of Dallas President Robert Kaplan. I asked him about the rate hike timing, the economic cycle right now, and why he's worried about growth coming down.
The reason I think growth may well slow, the fiscal stimulus is helping us this year, and we've been expecting that some of that effect will fade in 19 and 20. That's to be expected. And underneath, then, in the economy, GDP is made up of growth in the workforce and growth in productivity. And workforce growth has been solid, but we think it's going to start to be challenged because of aging. We're pulling more people into the workforce. That's a good thing. But we are aging as a society. Workforce growth, as a result, is slowing. This is why training, skills training, things that get people into the workforce is so important. So then the question is, can productivity grow? And that's going to be based heavily on more business investment, technology, and a more adaptable workforce. And that's the thing we don't know. But I would say with corporate profit growth slowing down and maybe decelerating into 19, that probably creates a headwind for more CapEx and more investment.
Well, we've got another interest rate hike that we're expecting in just the next couple of weeks when the Fed holds its last meeting of 2018. And, Robert, going into that meeting, you've got the Wall Street Journal editorial board saying, hold up, Federal Reserve. They should rethink. They say start with the Fed, which should rethink its December rate increase. No other major central bank is likely to raise interest rates soon. And America is not an island. There's a lot going on internationally that maybe we should not be raising rates 4 times this year. Your reaction?
Yeah, my reaction is we've raised rates now 8 times over the last 2.5, 3 years. We're now at 2 to 2.25%. I think we're getting close or approaching a neutral, where we're neither accommodative or restrictive. And I think at this stage, my own approach will be to avoid being rigid or predetermined in terms of our next steps. We're going to be use the lingo data dependent, and that means I'm going to be very sensitive to talking to contacts, looking at data, understanding what's going on with businesses, looking globally, and I think we'd be wise to be very patient and gradual from here, because I think we are approaching a neutral stance, and we've got some of these headwinds that you and I just talked about.
So you said that oftentimes when rates move, it's a lag in terms of when it actually is felt, right? So we've seen 3 hikes this year. What's your timing in terms of how this affects and takes impact?
Well, you never know exactly what the lag is, but my own working thought in my mind is 6 to 12 months. So the thing I've been saying and talking to my team about and around the FOMC table is I'm very conscious of the fact it's possible that the U.S. economy could look very different in the first half of 2019 than it does today, because you've got these cross currents with the fiscal stimulus fading, monetary policy taking hold, other trends going on, tariffs, input costs, global growth decelerating. And so I think the way to deal with all those uncertainties, in my position, is to be willing to be very focused on data, not be rigid, not be predetermined, and to be patient.
And speaking of global growth, China saw growth at 6.5%. Sounds good, but it's slower than a lot of people thought. Japan contracted 0.3% in the last quarter. Europe is really mixed. Germany's a lot worse off than people thought. And then, of course, you've got Britain exiting the European Union. How important are these global issues in terms of its impact on America?
I think global growth decelerating eventually, in my judgment, will have some spillover effects to the United States. And the other reason we see it significantly, almost 45% of S&P 500 companies, their revenues are outside the United States. And so while you may not see it as soon in the U.S. economy, you will see it among our leading companies because they're very global.